what's number one on your list?
Number one, so I know you're talking about the market sell-off all day, but
no, we haven't. You know what? We haven't touched on the markets at all.
Well, they're down a lot. You should check it out. No, I like Black Monday. The hashtag is trending on Twitter, which is one of the rare times I've ever seen a market move or anything in finance, economics trend on social media. It really tells you like people are really noticing this one. I also saw just sort of stock market was trending on Facebook, but that hashtag Black Monday, people are tweeting about it who don't normally tweet about markets. You know, in the past, we didn't have, like, social media to, like, gauge public mood like this, but now we can sort of see which stories are really seeping out into the public consciousness.
I like the fact that you brought this up and, of course, pointed out that in 1987 and in 1997 and in 1998 and 2001, we didn't have social media.
Right.
Chris, how important is it to gauge the mood of if you will, the man on the street or the man on Twitter, who isn't necessarily, as Joe points out, an investor?
Yeah, I would say that, we've had periods of fear and uncertainty in the past. This is nothing new, and Twitter and social media is only, perpetuating and sort of raising those anxieties and fears more than it would have in the past.
So it becomes,
just
it becomes
before
an
this
echo
interview, I
chamber,
thought
in other
about.
words.
Absolutely, and I thought about two prior. We've had many corrections, 8, 9, 10 corrections since the bull market began in March of '09. I can think of a couple. We had in the second quarter of 2010, when we had the BP oil spill, we had a mini correction there, especially in the energy and materials sector, and a nice rebound right after that. And more recently, it was August of 2011, almost 4 years ago, when the S&P downgraded the U.S. debt, and I can remember. I was on vacation that week. I remember coming in every day, seeing the market down 400, 500 points a day. Well, Q4 of 2011 was one of the strongest rebounds we've ever seen. So I just keep coming back to remain calm, stay patient, stay long-term focused. You can't ignore this news, obviously. You've got to pay attention to this. But we've seen many of these come and go, and typically they've been great buying opportunities if you're patient.
Patience, so important as an investor. Joe, what's number two on your list?
All right, another thing that I was watching is the South African rand. So like all these commodity emerging market stories, currencies, it's been slammed. But the intraday chart of the rand last night was absolutely crazy. We saw this massive plunge, or as you can see on the chart, there's dollar rand. So when it surges, that means the dollar is strengthening against the rand. Huge move to over 14. And then, it calmed down a little bit. But that was one of the more dramatic moves I can recall in any of these currencies. And speaking of social media, in South Africa, the hashtag stronger than the rand started trending and everything. So I saw it was like, whatever it was, someone tweeted like one-ply toilet paper, hashtag stronger than the rand. But that's a rare move. And so that's even within this emerging market commodity currency sell-off, that was pretty intense.
One thing I do want to add to that is the Japanese yen has strengthened by 4% today.
That's incredible. Yeah, I mean, think back to a few weeks ago. You just saw this. There was this incredible dollar bullishness. The U.S. was going to be the first to hike. Everybody was bullish on the dollar. So it's not that people are necessarily negative on it, but the expectations of a September hike have come off, and so people are really buying the euro and especially the yen.
Joe, we've heard the opening bell, and in the first few minutes of open exchange on the NYSE and the NASDAQ, the selling, as we knew, would be vicious. We're already down almost 500 points on the Dow, 485, but the numbers keep dropping. I'm trying to keep pace with it. In excess of 62 on the S&P 500. In both cases, good for a drop of 3+%. The NASDAQ, though, truly is where the action is. The NASDAQ is down more than 8%.
That's unreal. That's unbelievable. That's an incredible move.
Chris, you preach patience. It's tough to be patient when you see markets moving this quickly.
It is very tough. We're, here at Eaton Vance, in a lot of our equity strategy, we're focused on high-quality investing, stocks that have long-term sustainable business models, can pay solid dividends, have stable earnings. We like areas like consumer staples, consumer discretionary. We think the U.S. consumer is actually in pretty good shape here, given the low oil prices and the housing market and jobs. In addition to those sectors, we like telecom and healthcare. So think names like Altria in staples or Home Depot in consumer discretionary, Medtronic, Verizon in telecom. So those are the kinds of stocks we are tending to own right now in our large cap portfolios, high quality dividend paying stocks, ones that can really weather the storm that we're seeing right now, and then add on weakness if you really like those names long term.
Chris, the S&P 500, I should point out, is officially in correction mode now, having dropped more than 10%. At what point, again, going with this patience idea, at what point, you know, or at least for how long, do you close your eyes, plug your nose, block off your ears, you know, and then wake up like Rick Van Winkle? How many days or weeks from now?
Well, I mean, the correction was long overdue, and corrections are really healthy. And let's face it, valuations were a little stretched in the market at 16.5, 17 times earnings, exceeding where the fundamentals were for the market. So at some point, you go back and you work on your models and you look at your earnings models, and we have a team of analysts here that we work with. And when those valuations come more in line with those fundamentals, and they're closer with some of the names I just mentioned, which happen to be names that we own across many of our products, that's when you feel confident to begin adding. So it's for us, it's a name-by-name, stock-by-stock exercise. We're not technicians. We're not looking for a certain level in the markets to a price level to all of a sudden say that's the buy signal we're in. Certainly, for those who do look at technicals, and we do pay attention to that, it's pretty ugly right now. There's really almost no bottom in sight. So you know, again, we've seen these before. I think, you know, a lot of investment pros have been on vacation.
Well, they're back at work. I think they're back at work this morning, whether they're here or whether they're in the Hamptons or on Cape Cod.
They're back at work this week.
Chris, hang on one second. Joe Weisenthal is still with us. We're going to get to the third item on his list, but first we need to check in with Julie Hyman for a market update. Julie, I'm looking here, one headline on a Bloomberg terminal. The stock 600, the European benchmark, heading for its worst day since 2008. But that's broadly reflective of what's going on at the very least, stocks right now.
Yes, you alluded to some of the stats that we were watching thus far this morning. So let's take a look at the major averages if we can, and the huge sell-off that we are seeing, particularly acute with the NASDAQ down 8%. Just a reminder here, the so-called circuit breakers on the major averages are activated when they fall at least 10%. And then you see a pause in trading. So we're not down that magnitude as of yet, but nonetheless, and I haven't run the numbers yet because the session is just beginning, in terms of when's the last time we've seen a drop of nearly 1,000 points on the Dow Jones Industrial Average. So let's just take a round trip around what we're looking at. First of all, you mentioned the correction for the S&P 500. Here we are. This is from the high on May 21st through the trading today. We look at it close to close, so we'll see where we close out today. But right now, the S&P 500 is down 10.7%. The NASDAQ in a correction and the Dow in a correction. So the question is, now that we've entered that correction of at least a 10% drop, where do we bounce from here? Since so many people have been calling for that correction and a sort of flushing out, if you will. Let's take a look at some of the biggest declines in terms of the stock movers today, and really some eye-popping numbers in terms of percentage declines. We've been watching these momentum stocks. We were watching them last week, the so-called Fab Five, the FANG, whatever you want to call them, the leaders of the year, the momentum stocks that are now selling off very, very sharply. These are the companies that have really supported the gains for the year in the S&P 500 that are now dissolving. But it's not just them. Take a look at your guest, I think, just mentioning high dividend yielding stocks, so the sort of blue chip stocks. So a company like General Electric that has a dividend yield of about 4.4% is also selling off. So General Electric down very sharply today. Exxon and many of the oil stocks are selling off. And speaking of oil, let's take a look at those oil prices once again, because we have seen oil and commodities be a leading indicator. This Bloomberg Commodity Index, by the way, is trading at its lowest since 1999. It's an index of 22 raw materials. Crude oil, 38.25, so not just below 40, but below 39 this morning. The 10-year, want to take a look at what's going on with treasuries as well, because we are seeing buying in treasuries as people shift assets around and are risk off in this environment. 1.92%, the yield on the 10-year, below 2% for the first time since April. And finally, you guys were talking about the dollar. I wanted to bring it up because it is at a 7-month low. The DXY dollar index, if we have that, is also trading lower, sharply lower this morning as we watch the big sell-off continue. And again, this risk aversion, that would be the big theme as we look across asset classes, Erik.
Julie, thanks very much. A great market update from Julie Hyman. Chris Sunderland still with us from Eaton Vance. Chris, we have wiped out gains all the way back to February of 2014. Today's drop on the Dow, at times in excess of 1,000 points, the biggest since December 1st in percentage terms, 2008. Do you step in right now and catch the falling knife looking for value, or do you wait, and if so, for how long?
No, I don't step in right now. I think the sell-off will and probably may continue, and volatility is here for a while. But I would expect, I would be hopeful that we could see some positive news out of China this week. Let's face it, that's the overriding concern, China growth concerns. If they step up and mention cutting interest rates or lowering the reserve requirement, there's a number of other things they can do, injecting stimulus, things on the tax front. I saw that they had just allowed government pension funds to invest up to 30% in their stock market. So there's a number of things that they can do. They have further to go on interest rates. They can cut that quite a bit further. So I would look for something like that, and all of a sudden you come in one day and you see that bounce, and you see that all of a sudden a little bit of calmness come back into the markets, and that could be the opportunity to go back into the markets. So keep some powder dry.
Chris, lest I forget, Joe Weisenthal, very quickly with your number 3 item.
So the last thing, we talk about all these financial markets, and it's paper falling, but there is a real economy effect, especially in commodities. We saw the CEO of Fortescue Metals coming out and slamming, quote, market vandalism, unquote, for what he says is the overproduction, refusal to cut back, crushing prices in commodities. This is where, like, the real-world economic pain and fear is happening. We saw a commodity CEO last week talk about blaming short sellers in the copper space. It's one thing to look at stocks and talk about the correction and all that. When you go to that focus, you see, like, major wealth evaporation, major panic from some of the people in this industry.
Chris, when you look at the oversupply in commodities, who do you blame, the commodity producers or the high-yield investors who finance them?
I think some of the producers are to blame, but I come back to, again, we had such massive overcapacity. This is a global credit bubble that we've been in, and again, I come back to China, led by China and a lot of the emerging market countries. So what we're seeing impacting commodities and any other credit-related instruments is a result of this deflating global credit bubble. So while some producers are to blame for the oversupply and the decrease in prices we're seeing, it's largely a demand issue, and this massive slowing of global demand led by China. So it was only a matter of time. The strong dollar, not just recently, but not too long ago, was also a contributing factor to weaker commodity prices. So it's not surprising. I don't know, again, where the bottom is in that. No one has ever been able to time commodity prices, that's for sure. But we are staying underweight the energy sectors. That could be an opportunity months down the road, but we are staying underweight there because we still see downward earnings revisions. We think a lot of the dividends in the sector, with the exception of a few high-quality energy companies, could be at risk of getting cut as well. So we're paying attention to that.
Chris, it's terrific having your perspective this morning from Boston. Chris Sunderland, he is a director and institutional portfolio manager at Eaton Vance. And, of course, Bloomberg Markets managing editor Joe Weisenthal, anchor of What'd You Miss, which you will catch this afternoon at 4 o'clock. Joe, thanks very much.
Thank you.